All right, everyone, welcome. Let's get started with our lecture on accounting for decision-making. Today, we're jumping into a concept that is, and I'm not exaggerating, at the very heart of almost every business you're going to encounter in your careers. Unless you plan on running a cash-only hot dog stand, this is for you. We're going to trace the entire journey of what I like to call a promised dollar. Now, in the world of accounting, we have a more formal name for this, accounts receivable. And trust me, understanding this deeply isn't just about getting a good grade. It's about learning how to read between the lines of a company's financial story, a story that the big, shiny sales numbers will never tell you on their own.
So, to get us started, let's just chew on this question for a second. It's really the foundation for everything we're discussing today. So, you've got a company that made a $100,000 sale. Awesome. And you've got another company with $100,000 cash in the bank. Also awesome. To most people, those might sound pretty similar, right? But for you, as future managers and analysts, the gap between those two scenarios can be the difference between a thriving business and one that's about to lock its doors for good. It all comes down to the difference between accrual accounting, which is the standard for almost every company, and plain old cash. A sale is recorded as revenue, sure, but it is not cash. And cash? Well, cash is the oxygen. It's what you use to pay your employees, to keep the lights on, to invest in new projects. That money in the bank, that's real. That sale? For now, it's just a promise.
And that really brings us to our first major principle, one that honestly a lot of new entrepreneurs stumble over. A sale is not cash. It's the promise of cash later. And if you start believing that a big sales number on your income statement means your company is swimming in money, you're falling for a very dangerous illusion. See, under accrual accounting, we have something called the matching principle. We recognize revenue when we earn it, and we match the expenses it took to earn it in the same period. This is fantastic for seeing if you are profitable over a quarter, but it tells you absolutely nothing about whether you can make payroll on Friday. You can literally be a profitable company on paper and go bankrupt because you have no cash to pay your bill.
Okay, so let's get into the technicals. From an accounting perspective, what is this promise? It's not just a handshake, it's a real, legally enforceable claim. And because that claim has future economic value, meaning we expect it to turn into cash, we have to record it on our balance sheet as an asset. This all ties back to the revenue recognition principle, which is a cornerstone of accounting. It says you record revenue when you've satisfied your end of the bargain. You've delivered the product, you've done the service. The moment that happens, you've earned it. But remember our fundamental accounting equation. Assets must always equal liabilities plus equity. So if we increase our equity by recording revenue, something else has to go up to keep things in balance. That something is an asset, and that asset is the customer's promise to pay you.
So we have to record this promise as an asset. What do we call it? Where does it go? This leads us to the star of today's show, the specific account known as accounts receivable.
Let's break this definition down, because every part of it is important. Money owed for goods or services delivered. That connects right back to the revenue recognition principle. We've done our job. On credit, that's the key. That's what creates this whole situation. But now, pay very close attention to this last part. Recorded as a current asset on the balance sheet. Now, what does the word current mean in accounting? It means we expect to convert this asset into cash within 1 year or one operating cycle. And that classification is hugely important. It means accounts receivable is a major part of a company's liquidity, its ability to handle its short-term bills. An analyst will look at your AR as part of the current ratio to see just how liquid you really are.
Okay, let's make this real. Let's look at a hypothetical company, Creative Canvas Co. So, step 1, they finish a big design project for a client. Right there, at that moment, they have earned the revenue. Step 2, they send out the invoice for $5,000. This is the formal "you owe us" document. Now, step 3 is where the accounting happens. We have to make a journal entry. Remember your debits and credits. To increase an asset, we debit it. To increase equity through revenue, we credit it. So we are going to debit accounts receivable for $5,000. That makes our assets go up. At the same exact time, we credit sales revenue for $5,000. That makes our revenue go up. But notice what didn't happen. No money changed hands. Their bank account balance is exactly the same as it was a minute ago.
So up to this point, it's all been pretty straightforward, right? Record the sale, record the asset. But now we get to the really interesting part. This is where accounting stops being just bookkeeping and starts becoming a tool for judgment and smart decision-making. We have this big list of promises sitting on our balance sheet, but the big question we have to ask ourselves is every promise worth its full face value? Is a dollar that's been promised really the same as a dollar you can hold? And the answer, of course, is a hard no.
And this is just the cold, hard truth of doing business on credit. It's always a risk. Some of your customers, unfortunately, will go bankrupt. Some might dispute your invoice. Others might just disappear. For all sorts of reasons, some of those promises are going to be broken. Any business that just assumes it will collect 100% of what it's owed isn't just being optimistic, it's being irresponsible. It's actually misstating its own financial position. And this isn't just my opinion. This is a core requirement of generally accepted accounting principles. We're guided by something called the principle of conservatism. And what that says is when you're faced with uncertainty, you should always choose the option that is least likely to overstate your assets or your income. We have to be cautious. So that means we are required to report our accounts receivable not at their total invoice amount, but at their net realizable value, or NRV. Write that down, net realizable value. That's the amount of cash the business actually realistically expects to collect. And our job is to figure out what that number is.
This chart really shows you the problem perfectly. The whole donut is the total gross accounts receivable of $100,000. That's what you get if you just add up all the unpaid invoices. But based on past experience and looking at who owes the money, the management estimates that the purple slice, that $8,000, is probably not going to come in. So the real conservative value of this asset, its net realizable value, is only that bigger $92,000 slice. This is an estimate, looking into the future. And the whole puzzle for an accountant is, how do we properly and systematically account for that risky $8,000 slice?
So how do we do it? How do we apply that principle of conservatism when we don't know for sure which specific customers won't pay? We can't just guess. Instead, accounting gives us a really elegant solution that accepts this uncertainty. It's a powerful estimation technique, and it's called the allowance method.
Now, this is a really important term, so let's make sure we're clear. The account is called the allowance for doubtful accounts, and it's what we call a contra asset account. Just think of contra as meaning against or offsetting. A normal asset, like accounts receivable, has a debit balance, so a contra asset has a credit balance. Its entire job is to be paired up with a specific asset and reduce its book value. Now, you might be asking, why do we do it this way? Why not just directly lower the accounts receivable account? Well, it's because we want to preserve that original gross number. This way, anyone looking at the balance sheet can see both the total amount that's owed and our estimate of what we think we won't get. It tells a much richer story.
And this estimate isn't just pulled out of thin air, it's a data-driven process. The main tool companies use is what you see right here, an AR aging schedule. And this is just a beautiful practical example of risk analysis. Let's walk through it. Management has sorted every unpaid invoice into buckets based on how late it is. Look at that first column. $70,000 of the receivables are fresh, 0 to 30 days old. Based on history, the company figures it'll probably only lose about 1% of that, which is $700. Now, let's go to the next bucket. For invoices that are 31 to 60 days late, the risk goes up. The uncollectible estimate jumps to 5%. And you can see the pattern, right? The farther to the right we go, the older the debt gets, and the chance of collecting it just plummets. For invoices over 90 days late, management is realistic. They expect to lose half of that $5,000. This is what risk management looks like in accounting.
So by doing this aging analysis and then just adding up the estimated bad debt from each of those buckets, the $700, the $750, the $2,000, and the $2,500, the company lands on its number. The required balance and its allowance for doubtful accounts should be $5,950. This is their best, most educated guess of how much of that $100,000 in promises will likely go bad. So this $5,950 becomes our target. The next step would be to make an adjusting journal entry to make sure that allowance account has exactly that balance.
And this, everyone, is the moment it all comes together. This is why our course is called Accounting for Decision Making. We've done all the calculations. We've landed on this very specific number, $5,950. But so what? Why does it matter? It matters because this number and the analysis that created it is a critical piece of information for making really important business decisions.
This slide just perfectly captures one of the most common mistakes that new managers make. So the naive manager on the left sees $100,000 in sales and immediately starts thinking, great, we can expand, let's hire that person we wanted. They are looking at the top line number and thinking it's cash. But the informed manager, the one I want you to be, sees the net realizable value. Let's do the math. It's the gross AR of $100,000 times our allowance for doubtful accounts of $5,950. The real expected cash value from those sales is only $94,050. That manager isn't dreaming about hiring. They're focused on financial stability. The exact same business, but this one calculation leads to two completely different and much smarter strategic paths.
Let's really get inside the head of the manager at Creative Canvas Co. Let's role play this. So she looks at the income statement and thinks, wow, fantastic. Sales are up 20%. I am killing it. Maybe now is the time to finally hire that senior designer we've been wanting. But then she opens up that AR aging report that you, her accountant, just gave her. And she thinks, whoa, wait a second. My total AR is $100,000. But look, 10,000 of it is over 60 days old, and another 5,000 is over 90 days late. That's 15,000, 15% of my receivables from clients who are seriously behind. That's a huge red flag. And just like that, her entire thought process changes. Okay, forget hiring. What does this mean for my cash next month? Am I going to be able to cover our $50,000 payroll? Can I make the rent payment without sweating? Before I even think about adding another salary, my #1 job is to fix our collections. I need to call these clients today. See how that detailed accounting report didn't just give her a piece of information? It completely changed her strategy from grow to protect.
So as we start to wrap up, after going through all the principles, the mechanics, the journal entries, and the analysis, what's the one big thing you need to walk away with? What is the core lesson here for you as a future business leader?
This is it. Accounts receivable is so much more than a line item on the balance sheet. It's a diagnostic tool. It tells you a story about the health of the business. If your AR is growing and getting older, it's not just a sign of a future cash problem, it could be a warning that your product quality is slipping and customers are disputing charges. Maybe your customer service isn't great. It might even mean you're selling to the wrong kinds of customers who are financially unstable themselves. So managing AR well isn't just an accounting job, it's a core part of managing the entire company, from sales to operations to customer service.
And that leads me to my final thought for you today. I want you to remember this as you move forward. Financial statements are not just numbers, they're narratives. They tell a story. So when you're looking at a company, I want you to ask yourself, what story is their accounts receivable telling me? What does it say about the promises this company makes and its ability to build relationships where those promises are kept? If you can answer that, you'll know far more about that company than the sales number could ever tell you. Okay, that's it for today. We'll continue this next week when we talk about inventory.